Hey, everybody. Welcome to the Build Your Own Economy podcast. This is David here. I have my special guest today, as one of my friends says, a real treat. His name is Raul Gomez. He is a financial advisor with Build Your Own Economy Wealth Advisors. He definitely knows what he's doing when it comes to money. He has the ability to manage your assets at a high level, and he's going to share with you exactly what it is and what it takes to work with him, but more importantly, what you should be thinking about while you're investing your money, because that is the most important thing you need to know today, especially in this economic time. So, Raul, tell us what is going on in the market today.
Oh man, not a whole lot of good stuff is going on in the market today, or all of 22 for that matter.
Define not a lot, a whole lot of good, or not a lot of good.
Um, the market's just been kind of trading on a downward slope for all of 2022. So we continue to put in lower highs and then go in a little bit later and put in a lower low, and we're not even full out into this recession yet.
So you think we're in a recession?
Well, technically, we are in a recession. We've been in a recession since halfway through 2022, which a recession is two negative quarters of GDP. So GDP is gross domestic product. Just basically means two quarters of a shrinking economy is textbook definition of a recession. Even though the government then went and changed what the actual definition of a recession is, so now the government's like, well, that's not really a recession. But I mean, it's a
So do you
recession.
do you, I mean, based on technical, yeah, sure, but do you feel like we're in a recession right now?
I don't think I do feel that based on technicals we are in a recession, but I don't think based off of the impact on the economy that we are feeling what an actual recession is because unemployment isn't high enough. When unemployment is high enough, then that's when we're actually going to feel the recession, which everybody believes that to be 2023.
So we're thinking that early first quarter, second quarter, we're going to see a drastic decrease in unemployment, or increase in unemployment rather.
Well, I mean, it kind of it sucks to say, but that's what the government said. The government said our goal is to get unemployment up because they know that the only way that they can truly control inflation is by getting unemployment up. And so it kind of sucks when the government says, well, guys, our goal is to increase unemployment, which basically what they're saying is our goal right now is to make sure that people don't have jobs because
Man,
that's really the only way that we're going to really be able to control inflation. Even though inflation has already been starting to trend down, I mean, the every inflation report every month comes in a little bit lower, which is great. It's still astronomically high. It's still above 7%.
so I watch, just from looking at the business owners that I work with. I look at their hiring trends. I ask them how their business is going. Are they hiring? Or what are they doing? And for the majority of them, not very many are hiring, right? Not very many are expanding in the workforce. They may be expanding in volume of business, but the workforce is not increasing. I look at, just because I'm just thinking out loud, but I look at the seasonality of every business right now, which is retail, is where it's at because it's Christmas. But I mean, I would venture to guess in the next 60 days, we're going to see the reports for each of the retailers reporting their sales, their earnings, and if they hit their targets. And I don't know about you, but I don't know if they're going to hit them. What do you think about that? Do you think they're going to hit their sales targets for the quarter?
Well, we haven't gone into an earnings recession yet. So that's going to eventually happen. I mean, all the stats that come in, and don't quote me on the stats, but at least to what I've
I'm
seen,
going to quote
the
you.
consensus with most CEOs is we're going into a heavy recession. When like 90% plus of CEOs for all major companies are saying we are preparing for a recession, I mean that's not a very optimistic look. But also like everything else, recessions are like a self-fulfilling prophecy. You know, the more you say that we're gonna go into a recession, the more people actually prepare for a recession, the more people hold on to cash, the more people sell stocks, sell assets, the more we actually go into a recession. So it's one of those things that I mean, recessions are self-fulfilling because the more you say we're going into one, the more we actually go into one.
But do you think that the job that these retailers are going to hit their marks?
No, I don't believe so.
any of them, right? I mean, I only by observation. I went to Best Buy last weekend, and they were full of everything. I didn't see anything missing. Where there was last 2 years, you went to Best Buy. I mean, if you could that first year, but the second year you could, and there was no TVs, there was no PS whatever number now, and there was no laptops, there was no iPads, there's no phones. I went in there and I felt like they just had mountains of inventory.
Yeah,
And with that kind of thought, I'm thinking, okay, so they're probably they're probably over inventoried and probably overstaffed right now.
over inventory and overstaffed, which inventory is an indicator. An excess of inventory is an indicator of a recession. And then yes, I think overstaffed is a big issue. And you and I have had this conversation before, where I think since 2020 and 2021, and even 2020, I'm sorry, 2020, 2021, and 2022, employees have had a sense of entitlement where everybody feels like they're owed XYZ, and if they don't get it from one employer, they could very easily go and get it somewhere else. Like, let's say for example, people don't want to come into an office. If you don't give me the opportunity to work from home, I'm just going to go find somebody else that'll allow me to work from home. Man, those days are going to end here pretty quick, because when people cut jobs, they're only going to keep those key employees that, number one, have the skills, but actually number two, that have the um, I guess that have that work ethic, to where they're going to do whatever it is that they need to do to be able to keep their job. And I think a lot of people just have lost that over the course of the last 2 years. People feel so entitled, and a recession usually cleans house with that.
Yeah, there's not an underemployment, is overemployment right now. And you're right though. Most of the people that I know will, I always tell people, if you're a good employee, if you're a good team member, you have nothing to worry about. A company will find a way to keep great people. When somebody gets laid off, terminated, or during an economic time like this, it's tough. That just tells you a lot about the value of your job, the value of your skill set, and the value of your worth to the company. And that doesn't mean you're a bad person. It just means that, I mean, when somebody comes to me, it's very interesting because I get people who come to me and say, "Oh man, I can't believe this." I mean, maybe not recently, but over the years, like, I can't believe they let me go, and I did everything there. I was the number one employee of the year there, the universe, and I'm like, apparently you weren't, because if you were, you would have your job, man. I'm sorry, but people have high regards for themselves in business today, and I mean, the market tells you what you're worth. The market tells you what you're going to keep. And the market being the employer, the payroll, the economy, whatever that may be. So you're exactly right. I think there's going to be more people unemployed in the next 90 to 120 days than we've seen in a long time, especially after the holiday season,
I
especially
would
after
agree.
that.
Yep.
And which, by the way, makes it good for people like you and I, who are looking to build teams, who are looking to help people who are looking for an opportunity. So tell people what you do, Raul. What do you do?
So I'm a financial advisor, which I'm probably gonna have to send this video to compliance. But I'm a financial advisor, and I assist people in just investments with money, as far as just kind of figuring out a game plan, as far as where they want to take their finances, and that could be done one of two ways. That could be done by doing an analysis, investing money for them, or just by sitting down and developing a comprehensive financial game plan that they can implement themselves. It can work either which way.
So somebody would meet with you if they're looking to invest money in what kind of things?
So for me, it's strictly securities. So that would be stocks. If you want to create a portfolio, then that's something that I can help you with. Obviously, we have to go through several conversations and figure out, number one, what is your risk tolerance. Number two, what is it that you're trying to accomplish. But the thing is that a lot of the times people want to invest in the market, or they want to invest in assets, and it's not because of a lack of information. We live in the age of information. I mean, information has never been more accessible to people than it is today. Yet the reason why people don't take action isn't because of a lack of information, it's because of uncertainty. They don't have anyone to say, hey, you know what, actually, I do feel like that's the right decision for you. Let me explain to you why, and kind of push them along the process. I mean, I correlated very similar to you with taxes. when you help clients with taxes and their tax liability and finding out tax strategies, the majority of the stuff that you help clients with, realistically, if they sat down for, let's say, 10 hours, they could probably figure out a way to implement those strategies. But the reason they don't do it is, number one, it's confusing. It's very easily, there's a lot of opportunities for you to mess up, and really you lack the certainty because you've never done it before. So you could find the answers, but because you've never done it before, you'll choose not to do it. So I think taxes and investing kind of work very similar to where people have access to the information, but they don't have the certainty. So then they choose not to take action, and sometimes they just never do anything. So my job is to help them through those uncertainties and develop a game plan.
Okay, so somebody like myself wants to invest some money in the stock market, for an example, and I don't know, maybe I know how, but I'm not certain about what I should invest in or how I should diversify it, right? Because you should. I mean, personally, I don't know enough about investing in the stock market, but I would say I wouldn't put all my money on one thing.
Right.
uh, I mean, just a rule of mine. You got to have a little bit more than just everything on Tesla,
Sure. Or
especially
or
right now.
or an FTX token.
Or yeah, or in Twitter stock right now. Anyways, this is funny. But I would come to you with my money and I would say, hey man, help me figure out where I should do with this, and then you would do an analysis to determine what.
I would do an analysis to determine what it is that you're trying to accomplish and ultimately your risk tolerance. So like for you, I know that you're very, very heavy real estate. I mean, for you, the number one asset that you like to invest money in is real estate. And I think that's great. I think real estate is an amazing asset. I think real estate for high net worth individuals like yourself and a lot of the clients that you work with offers so many tax advantages. However, you're not just going to go buy a real estate property if it's not a good buy. I mean, you have to determine if it is a good buy and how much taxes are you going to save. And sometimes those deals for some people they're just not out there, or they just can't find them, or maybe they just want to wait a little bit and see how the market reacts over the course of the next year. So then why not invest it in a dividend portfolio that pays you 6% per year? Guaranteed, right? Something that's liquid. It's still going to be somewhat volatile because stocks are stocks, but generally speaking, like dividend stocks, those tend to be a lot more stable than growth stocks, like Tesla being a growth stock. I mean, that stock goes up and down very drastically. So take some money, invest it in the dividend portfolio, let that dividend portfolio pay you 6% income per year. Then maybe a year or 2 years down the line, you liquidate a portion of that and you're able to take some of that and go invest it in real estate. So stocks, when you put money into the stock market, you're putting money into the U.S. economy, and obviously the U.S. economy 2022 has been trending down and probably will continue to trend down in 2023. However, like let's say for example, people go and buy a whole bunch of junk on Black Friday. I always like to use this analogy. People will wait in line for 24 hours to go buy all of this junk on Black Friday because it's on sale.
Well, what's junk?
Yet, when assets are on sale, like they are right now, and probably will continue to be on sale in 2023, nobody wants to touch the stock market because, oh man, well, what if I lose money? But this is the opportunity to build wealth because we haven't had a recession in 14 years. 2008 was the last time that we had a recession. And I was pretty broke in 2008. So, I mean, even if I wanted to invest, I didn't really have a whole lot of money to invest back then. But now I'm in a different financial situation, and I mean, it kind of, I'm not trying to say that I want things to get worse, but I do see it as an opportunity for me to capitalize because of the fact that assets are at a discount, and I'm able to buy them and just let them sit, let them grow over the course of the next 5 to 10 years.
So for the definition purposes, because I want everybody to get this, if we're talking to assets, what specific assets are you talking about?
Well, for me, I mean, I'm strictly talking about stocks. I'm talking about stocks. I'm talking about growth stocks, dividend stocks, creating a portfolio. We could also look at bonds. You know, for high net worth people, we could look at municipal bonds because they have tax favorable advantages. But it's not just exclusive to that. I mean, circling back to real estate, which is your forte. I mean, there's going to be opportunities to buy real estate. I think over the course of the next year. Because I feel like real estate will take a step back and there's going to be more deals available. I'm not. licensed to talk about crypto because crypto's not a security, but a lot of people look at crypto as a great opportunity to build wealth. You have to keep in mind that that's a very speculative asset. But there's so many things that go on discount in a recession. But the reason people don't act is because recessions are they're very scary times, and when people are scared that they're going to potentially lose money, they tend to miss out on tremendous opportunities.
Oh, yeah, I would agree with that. So the fear that most people have right now is obvious that the stock market's still going to go down. Real estate still has some more to go down, and they're right. By the way, I believe that 100%. There's still some. We're not at the bottom of anything. We're
Right.
probably halfway there. And so you help me invest. You first determine my risk tolerance. You determine what kind of things I want to know. So what are some of the goals that you have right now with clients? Like, give me an example of a goal one of your most recent clients came to you with.
Well, so one of the most recent clients that we had, I mean, their goal is to retire in the next 10 years. That is their ultimate goal. And so like one of the things that we did for them is we did a combination of growth stocks and dividend stocks. And this is a strategy that I've talked about with clients, and I've talked about in some of my other videos. So let's say, for example, and please don't implement this yourself. If you're gonna do something like this, make sure that you talk to your financial person, your financial advisor. But one of the things that we like to do is say, okay, well, let's generate you a portfolio that pays you XYZ income on an annual basis. And then we're going to take that income and use that income to go and purchase growth stocks. So usually stocks fall into two buckets. You have your growth stocks, very volatile. They go up and down pretty drastically. And then you have your dividend stocks. Dividend stocks are what are called value stocks, and those stocks are more stable. They're still going to fluctuate with the market, but they're more stable because of
Like
the
an
fact
AT and
that
T,
like
right?
the
AT,
AT&T, like the Amazon, like the
Apple.
ones that have already experienced pretty much all of their growth, and at this point they're just rock solid companies that
So not
have
Tesla, not Tesla.
not Tesla's a growth stock, and I think Tesla has a lot of growth potential, but like everything else, I mean, they haven't experienced all of their growth, so they're not really paying dividends like other companies are. Companies that pay dividends are companies that are financially very, very stable. They've already established their growth, and so at this point, they know that really all they have to do is sustain, and that's why they're able to take some of those margins and deploy them to their shareholders in the form of dividends, and those are technically pretty solid companies. So let's say, for example, if you had $1 million and you say, well, where do I park this money? You take $1 million, you buy $1 million worth of dividend stocks, as long as that fits in well with your risk tolerance. That's something that we analyze. And then the income generated off of those $1 million in dividend stocks, we take that income and we deploy it into growth stocks. So you're only taking the income from your dividend portfolio, which is relatively a little bit more conservative, and you go and you deploy that into growth stocks. Now, there's other things that we need to factor in, like taxes, because dividends are taxable. But generally speaking, that's a great way to spread out the risk because you're only using the income out of that dividend portfolio to go and invest in growth stocks.
So okay, so we got this investment strategy, but let's say I don't want to go to you and I just want to go direct to the market. There's like all these apps now and stuff that they want me to use, you know.
Right.
I mean, just thoughts, like not on the apps, but I mean, why is it not a good idea? I mean, I said it like I want to diversify, but let's just say somebody thinks they know a little bit about the market and they go and they open up an app and they put, let's say they had a $200,000 and they put 25 here and 25 there and 25. They just bet. What's the risk in that for them?
I mean, there's really no risk if you want to do that and just go and invest in the S&P 500 index or the Russell 2000
What if
or
they
the
want to do a direct stock, direct hit?
so there are pros and cons to that. When you invest in one company and one company only, there's a great amount of what's called business risk. And what is business risk? Business risk means that if that company goes under, then there's a good probability that you're going to lose all of your money. Now, I'm not saying that that's going to happen with like the high tier companies, but usually the reason why we preach diversification, or if you're going to do that, if you're going to go and invest in Robinhood, you don't want to pay a financial advisor to do the investing for you. You're more than welcome to do that. But we always say, well, if you're going to do that, then buy into an index like the S&P 500 because that consists of the 500 biggest companies, and if one of those companies goes under, then it just gets replaced with a new company. So you're able to spread out the risk. For example, if you take all of your eggs and put it into the Tesla basket, well, Tesla could do exceptionally well. And I mean, Elon is a very smart dude. But what if Elon dies, right? What if something happens to Elon and they have to replace him with a new CEO and that guy just comes in and just totally messes
He
everything
can't
up with
die. He's
Tesla?
an alien.
That's
He's
true.
an alien.
He is an alien.
Alien.
But let's say he was a real person,
Okay.
like an alien, like he's from another country or another planet.
He's illegal alien. That's what I meant to
Okay.
say.
So there's a lot of risk when you just invest in one company and one company only. So
well,
that's part of the premise behind say, well, let's invest in an index or
well,
let's generate a portfolio.
so let's just say that I'm just saying. What if I did that because I want to save a fee? Okay, because I want to save a fee. I don't want to pay you. How much am I
Mhm.
really saving if I don't pay you?
Maybe like 1 to 2%
Okay, so one of my gain or of my portfolio
of,
or
of of the portfolio itself
on an annual basis,
on
monthly
an annual
basis.
basis. Yeah,
Okay, so if I had a let's say $100,000, $1,000 is what I'm saving.
correct.
Okay, 1 to 2 or whatever it may be.
One to
You know,
two.
one to
Yeah,
two. I
one to
only
two.
ask this because so there are a lot of people out there that are thinking that you're going to take all their money, and that's really what it is. Because I mean, I've talked to financial advisors in the past that have tried to take my business, and I've never really moved on them. But a lot of the times, I'm like, how much? It's because a lot of people don't disclose their fees.
Sure.
They reel you in with, hey, we can help you do an analysis, and then they're just like, well, you know, you get in the office, and now I'm like, man, I don't know if I'm going to pay this person, and then I don't want to know how much because you know, I always think of just personally, I always think of seeing statements so like 401k managers, right, or IRA managers, and those guys they make 3%, 4% on their clients' money in some cases from. It's not just from management fees; it's overhead, and they give you all these little charges that add up. They just don't say 4% or 3%. They add,
Right.
and that equals the percentage, right? And
Right.
so for the most people, I mean, I think that's the challenge for you is that most people just don't know how much you would charge, and
I,
I
I,
don't
I
think.
would I would
Go on.
agree, and unfortunately that happens a lot with like let's say mutual funds. So we don't do mutual funds. We go directly to the source and buy the stock for you, and we just charge an annual management fee. So when we tell you this is what we're going to charge you, that's exactly what we're going to charge you, and there's no hidden fees a lot of the times, and don't get me wrong, there's good mutual funds and there's bad mutual funds. There's good financial advisors, there's bad financial advisors, like everything else. But like mutual funds, a lot of the times what they'll tell you is, oh, we're only charging you 0.75% annual fee. But what doesn't get disclosed is that anytime that mutual fund does a securities transaction, there's a fee for that transaction that gets trickled down to you. So then we analyze mutual fund portfolios, and the clients are actually paying closer to like 3% in
Yep.
fees. But on the actual statement, it only says 0.75. Well,
Yeah.
0.75 is the basis fee, but every transaction, especially if there's multiple transactions in that particular mutual fund, then all of that is going to get trickled down to you.
This reminds me of looking at my electricity bill, and
Yeah.
it says you know, it says my kilowatt hour is like 8 cents or 9 cents, but then there's like all these little fees that if you add them up and you divide it by kilowatt, it ends up being like another 7 cents. And so I'm not paying 9 or 8, I'm paying 15 or 16. But we think, you know, if we don't really know or we're not really savvy enough to just add up, we're going to get screwed. And I think that's the same concept that people think about and
I,
don't think about rather. And that's the challenge, I think.
I agree. I agree. And but people need to understand too that whenever you decide to work with a particular financial advisor, I mean it's a commitment to you for as long as you decide to stay with the advisor or with the firm, and so that includes having conversations with you. That includes making adjustments as we move forward. That includes helping you figure out taxations, talking with your CPA, because all of that is important. And so people need to understand that all of that takes time. So you can't expect a financial advisor to work for free because that's their business. That's how they make money. That's how they make their livelihood. But at least me personally, I'm a firm believer that I mean transparency is key. So I'm always going to be very transparent. and I don't work for free, nor do I have the desire to work for free. But
You're not a
if
nonprofit, dude. Come on,
no,
man.
I'm not a
Nonprofits.
nonprofit.
Yeah.
But I will tell you that if you make the commitment to work with me, I will make the commitment to make sure that we get to where we want to get to, and disclose everything along the way, which is super important. But at the same time, some people, like you said, maybe they don't want to pay a continuous fee to an advisor. Maybe they just need an advisor to help them put together a plan, just a one-time deal. Then that can be done as well. And then at that point, depending on the level of complexity of the plan that you're wanting to design, you get just charged a one-time fee. We help you design the plan, and then you go on in your merry way. It can work either which way.
That's really good. So it's really do it for you or do it with you.
Do it for you or do it with you. Yeah.
Yeah, that's pretty cool. And does it do it with you? Is that significantly different in costs?
Well, there'll be more. It'll be a much larger upfront cost, but it's only a one-time cost.
Yeah,
And
got
once
it.
again, it depends on the level of complexity. Like if somebody comes and says, "Hey, man, I want to invest in real estate, but I also want to invest in stocks, and I want to
And
do
crypto.
crypto as well. Sure, I want to do a self-directed IRA, and they start getting really really complex with a bunch of stuff. I'm like, okay, well, that's not something that we can accomplish just in a month. This is going to be like a 2 or 3 or 4 month process while we find you all of these resources that you're wanting to utilize, and so the fee will reflect the amount of time that needs to be spent setting that up. Maybe someone just wants to invest in an index and they just have questions as far as what platform to use and what indexes they should buy. Then that's something a little bit more simple, and that can be knocked out in maybe 1 or 2 sessions, and so then the fee will reflect based off of that.
Got it. Well, that's cool, man, because I think a lot of people's hesitation is fees. A lot of people don't know what exactly a financial advisor does or is. I was told once, this was probably about 10 years ago. No, it might be less than that. I had a really good mentor at the time, and he said, you always got to have a few people around you. He says, you got to have a good attorney, you got to have a good banker, you have to have a good financial advisor, and you have to have a good accountant. Like these are the people you have to have you around. And I said, there's one more, and I added that about 3 years ago. You got to have a good doctor. Like you
Yeah.
have those people, that's like your dream team. And those are the people that you look to as your board of directors in life, not in business, in life. So whenever you make a decision, you consult with all of them, even your doctor. I mean, you can add your pastor in there, right? But a lot of the times that's probably one thing you go to first anyways, right? And but it's a dream team, and so you're part of that dream team for a lot of people, including ours. And a lot of our clients go to you for advice and guidance and mentorship and coaching, and more importantly, to manage their assets. I think managing of assets is, it's very a loose term. I actually don't like the term because when you say manage assets, to me personally, it sounds like it's I don't know, it's too vague. To me, it's just like you're managing my portfolio of investments and
But
whatever that may be.
yeah, no, I probably will take it one step further and just say, I mean, I'm helping you manage your money decisions, because ultimately that's what I'm doing. I'm helping you prepare for whatever financial decisions you want to make today and you want to make in the future, and so that gets pretty comprehensive, and that involves a lot of conversations. So, I mean, I'll sometimes I'll talk to a client. Usually, what I like to do, if somebody wants to chat with me, like we'll just do like a real quick 15-minute conversation, just so that I can see what it is that they're trying to accomplish. And sometimes I'll tell the client, you know what, I just don't feel like we're the right fit. I don't feel like we're the right fit. I don't think that I can help you right now. But let me give you some suggestions that you can implement yourself. Because let's say, for example, if somebody comes to me and let's say they only have $25,000 in the bank. That's all they have. They have nothing else. And they're like, man, I want to take all of this money and invest it, 25,000, and I want the 25,000 to grow to 100,000 in a year. We're like, whoa. So let's take a
Me
step
too.
back.
Me
Yeah,
too.
it's like everybody wants that. Maybe if you invested in crypto in 2011, that could have happened. But then if you held it to now, then it would be right back to where you started.
Yeah.
Um, but sometimes people have unrealistic expectations. Sometimes they're just not in a good financial place. Sometimes people have money in the bank and they have so much debt that it just doesn't make any sense for them to invest that money. I just say, you know what, you need to get rid of this debt first. I really tailor more to the clients that are they're in a better financial situation to be able to make those big financial investment decisions because I know that my service is better suited for them. And then those that I feel like aren't financially just there, I just kind of try to guide them. And that's nothing that I charge for. That's what the initial conversation is for, just so that I can say, you know what, here's some suggestions that I think you can implement. They're pretty simple, and I think it'll get you on the right track. And let's have another conversation in a couple of months or a year and kind of see where you're at.
Yeah, I agree with that. And there's a lot of the so I guess before we end here today, I just have a few questions I guess that would help people understand what what is it that if I were looking let's just say where are the majority actually it's a better question. The majority of your clients that you're finding today, where is their money typically before they come to you?
In the bank.
In a bank. Okay, so a lot of them are in a bank and they're just letting it accrue interest at some point there and maybe not much, but that's what they're sitting on.
Right.
Okay. And what
In the bank, or maybe a dormant retirement account, maybe something that they set up a while back, maybe a 401k from a previous employer, stuff like that. If I'm talking to business owners like to hold on to a lot of cash because they like that control, and business owners tend to like to deploy that cash either back into their business, other business ventures that are going to give them tax favorable advantages, or maybe go and buy another business altogether, which is a different conversation for a different day. But if I'm working with, let's say, just a regular professional, a lot of the times it's an old retirement account or just money that they have sitting in cash as well that they haven't done anything with just because they're too scared to take action because they don't know if that's the right decision. And somebody once told me that indecision is the worst decision that you can make.
it
And what I
is.
mean by that is a lot of the times because you're too scared to make a decision, whether it's right or wrong, you make no decision. And making no decision, it is the worst decision. Because if you make a decision and it was the bad one, you're able to learn from it. Be like, okay, well that was wrong. I probably should never do that again. And then if you make a decision and it was a good one, and you're like, hey, you know what, that worked out. I need to make more decisions like that. But if you don't make any decisions, there's no growth. You can't learn, and you just stay stagnant forever.
You just get stuck with your money in the bank.
Hmm.
I look back at my parents. My parents were that way. They just had everything in a CD or in a money market, always thinking that they needed to have that cash there. I mean, my parents were not rich at all, but when they had a little bit of cash, they always wanted to put a $5,000 CD in the bank because it gave them, I don't know. Back then, obviously, it's probably like 5% or something.
Well, it's five
Today,
percent now. I mean, fixed rates are astronomically high. We haven't seen fixed rates this high in a very long time. But I
right?
know in talking to some of my older clients, I remember back in the day when mortgage rates were like 17 or 18%, CDs were like at 12%, like guaranteed.
Yeah, people.
And there's a possibility that we might actually get to see that again in our
Well,
lifetime, depending on how bad inflation gets.
well, what's interesting to me is that people tell me that all the time. Well, yeah, interest rates are 17%. I'm like, yeah, but the cost of real estate was very relatively lower in comparison. Well, actually, wages versus the cost of real estate were not so disproportionate as they are today. So, like, the average American just can't buy a home anymore. Back then, people could buy the home with their wages and afford the 17%. Today, nobody can. I mean, I mean, if you don't make at least $100,000 now, and that's not even a lot of money in most cases, you just not can't you can't buy a home. You
You
can't
can't.
literally you just can't afford it, and it's so. But it's because the price of real estate is just ridiculous. I'm looking at it's just interesting to me. I was looking at a piece of property just the other day on Zillow. I'm looking at like beachfront stuff, and there was a property that sold for like $500,000 in 2017. And that, I mean, that's a lot of money then. They're selling it for like 1.4 million now. And I'm like, three times the price, man. Like three times the price, plus an interest rate that's ridiculous. That thing's never gonna sell. Never gonna sell. Or I've seen others that were $150,000 5 years ago, and now they're 450. And I'm like, nobody can afford this stuff.
Yep.
It's just overinflated. The market just got too crazy. People just had too much money, and now we got to see that go to the floor. I mean, sucks to
We
say.
we do, and believe it or not, the government is keeping a very careful watch on that because that's how they gauge whether what they're doing is working or not working. When the head of the Fed says if you are a new potential home buyer, you might want to wait for the market to reset before you go and buy a home. When the head of the Federal Reserve says that, and he did say that, then you're like, man, well, maybe maybe I should wait a little bit, right? Because I hate to say it, and I mean, I never thought I would see the day that this would happen. But I mean, the American dream used to be you buy a home. Now it's like the American luxury. Now, if you want to buy a home, it's like it's no longer the American dream now, it's the American luxury because unfortunately now it seems like buying a home is a luxury. It's so difficult to do. You need an astronomical down payment. Homes are ridiculously overpriced. Now interest rates are just as high as the prices of homes. And something's got to give because otherwise nobody's going to be able to buy anything.
Yeah, I agree with that. Well, even at that, even if the price adjusts, which it will, if those interest rates don't drop at the same time, which I don't know if they are. I'm just looking at all this stuff and I'm like, man, there's no perfect time to buy. I haven't bought anything recently. We're still looking at multifamily, but for single family, I don't even think I'm not saying it's a bad time to buy. I think it's better than it was 6 months ago. But it's not as good as it's going to get.
I think that there's definitely going to be more opportunities to buy it as the inventory starts to pile up. I also think that new construction, as the new construction projects start to finish up, these construction builders. I don't think a lot of them may not have anticipated that the market was going to change this drastically, and they may not have the capital to hold on to those properties for extensive periods of time. So let's say, for example, if you're like a massive construction company, you build, I don't know, let's say 100 homes at a time. And all of a sudden, your 100 homes are not selling. You were counting on selling those homes over the course of several months, and maybe you sold half of them, but you still have half of them in inventory. Eventually, you're going to have to figure out how you're going to unload on those because those are costing you money because you don't have the capital
Yeah,
to
and they're
hold on to those
borrowing.
homes. Yeah,
Typically, there's a line of credit established to build, and that line of credit, that interest rate is going up.
you're right.
It's like at the floor for a little bit. So yeah, I see that. And actually, I said this to you, I think about 6 months ago, or maybe it was a little longer. I said, man, any builder, I'd be scared. I know that there's a shortage of homes. I get it. So they can say that, and they can say, well, if we're building, at least we know there's a demand. Yeah, but just because there's a demand, there still has to be somebody to buy it. I
Right.
mean, they still have to be able to qualify. It's not just because people need a house, they're just going to magically figure out how to get it. The interest rate has to make sense. Well, the cost. I'm seeing more new construction homes fall onto Zillow and Realtor right now than I've ever seen before that are pre-construction. I
Yep.
mean, they're floor plans, they're in the middle of construction, not even fully completed. I've never seen that before, and I'm seeing more of it because obviously they're trying to hook people right now, right before they do anything else. And so the way I see it is if I've got in our market 250 is probably the number for most homes right now. But if I had 250 to buy new construction and it's only 1,200 square feet, or 250 and it's a little older, but it's 2,000 square feet, and in a better established neighborhood with trees that's mature and near a school, rather than out in the middle of nowhere where most houses are being built today. I mean, dude, I've got a better deal at just going in the city and buying something that's pre-owned, if you will. So
A
I
little
think a lot
older.
of these
Yeah.
builders are about to get kicked in the nuts. I mean,
That's a very good possibility, and I just don't think that they prepared for how rapidly the market is changing. This market in real estate is not a flippers market because it's just changing too rapidly. If you find a good and like you said, there's never a perfect time to invest in real estate. Sometimes you just have to, if you find a deal and it makes sense to you and the numbers make sense to you, then pull the trigger and buy and hold that thing until it makes sense to sell it or refi or whatever. So if you're gonna buy and hold and you find a good deal, go for it. But if you're trying to flip in this market, it's changing so rapidly that you could very, very easily end up negative because it could
well,
change drastically from one month to the next.
it has to be a real diamond in the rough for it to be a good deal.
Yeah.
It has to be like real diamond in the rough. Nothing selling, man. So, all right, man. Well, I've got a lot out of you, man. I'm really thankful that you jumped on here and gave us some of
Well,
your insights. I'm hoping that many people can get a hold of you. So, how can they reach you to set up a consultation? They want to put their trust and faith in a financial advisor that cares and wants to help them invest their assets.
you know that that you can trust your financial advisor when he looks like Montel Williams. Right. That's right.
Didn't Montel say something? What does he say? He has a saying, doesn't he? So
So
how
so
do they
let
get a
let
hold of you, Raul?
so the best way to get a hold of me is via Facebook. Just look me up on Facebook. I'm connected with David. Or you can send me an email, Raul at buildyourown.economy.wealthadvisor.com.
Build your own. We'll put it in the comments here below, guys. So if you want to get a hold of Raul, he does do free consultations for anybody who's looking for somebody to help them get direction and help them understand where they should be investing their money right now. This is a serious time, by the way, for many of you who are watching this, either a business owner or your high net worth person or somebody who's got a little bit of money that they're sitting on. I know a lot of those people. I understand that. You can be fearful right now of what's going to happen, and most of us are. I am the same way, but there's some things that you can think of that I can think of right now that are very important to understand. That your money is losing money if it's just sitting in the bank, and it's not really making you anything. And if you have aspirations to be wealthy one day, it has to be a diversified portfolio, and you definitely have to have an advisor on your side that helps you manage that money, so you don't have to. So you can go out and do the things that you know how to do, whatever that is. Do it better because you have somebody else managing your money. So thank you, Raul, so much for being here today. Wishing everybody a successful rest of your day.